Hello, everyone. Thank you for being here. This is Rachel Gustafson, one of your presenters tonight. I'm joined by Brittany Jacobson, one of our other presenters. We're going to give it just another minute or two. We're expecting a few other people to join us. And right now, just so you know, you're all muted. You can hear me, but I can't hear you. We'll go through some technology pieces here in just a moment. So we're going to give it another minute or two. Okay, while we're waiting for a few other people to join us, I am going to jump.
Rachel, we lost you. I can't hear you anymore.
Thank you. Can you hear me now?
Yes, you might want to start that part over.
Yep. So when you first logged in, you should have seen one of these two diagrams here. It may have been this little guy with just the little pictures here. What you want to do is click the little orange arrow, and that should open up this box here. So I'm going to give you guys a minute to pull that up. After you've done so, there are a couple of places that I'm going to point out for you. The first being questions right here. I'm going to get my little highlighter so you can see it. So this questions area here, if you hit this little arrow drop down, a little box is going to open up so you can type questions. So if you're having any issues hearing or seeing us, please type in that box to let us know that you're having a technology issue, and Brittany or Carrie are going to help you get back on. The second place I'm going to point out is handouts. If you don't see the handouts option, let us know in the questions box that you're not seeing it. But there should be 3 handouts in there. And the first is our fiduciary pledge that just talks about what a fiduciary is and how we act as a fiduciary. The second piece is our bios for Brittany and I, a little bit about who we are and what we do for our clients. And then the third, which is where I want you to focus, is the, sorry, I'm blanking on it, the little booklet that we want you to open up and save to your computer. And it's going to give you some information as we're going along about, it's a great place to follow. We're going to point out some spots in there, and also a great resource for after the call. So if you're having any issues seeing the handouts, let us know in the questions box that you're not seeing it. And we'll be doing some polls throughout the seminar too as well. So I'm going to give you guys a moment to pull that up and make sure that you can see it, and let us know if you're not seeing it or you can't hear us.
Rachel, I believe everybody can see what you're talking about.
All right, I'm going to move on. Okay, let me just. Okay, here is a brief bio about Brittany and I. We're going to be co-hosting tonight. I'm going to start the first half, and she's going to finish the second half. We're excited that you're here with us tonight. We really wanted to be able to do this in person, but just with the recent social distancing and protecting ourselves and our families and our community, we felt this would be the best platform to do this. Brittany and I are both very passionate about financial education, so we're excited to have you here tonight so that we can share some information that I think is going to be really timely with everything that's been going on. And so what I want to encourage is that you ask questions. The best way to do that is in the little questions box that I had shared earlier. We are going to reserve time at the end to answer those questions. So please don't think that we're ignoring you if we don't answer them right away, but we're going to reserve that time for the end. Also, if as we're going along you run into any technology issues, please do let us know via the questions box. So this is just a little brief bio about who we are, some of our background. Like I mentioned, we are financial planners. We're really passionate about financial education and giving you tools that you can make more informed decisions. So we're going to start investment fundamentals. What I want to do before we dig in is do a brief poll, and hopefully all of you can see it. If you're on your phones, I am going to say you might not see the poll pop up. I'm hoping that you do, but just know that we're a little bit limited when you're on your phone. So I'm going to pop up a little poll for us. And this is just it's a census to let us know what investment types you're familiar with. I've just opened the poll, so you should be able to see it. The options are stocks, bonds, annuities, mutual funds and ETFs, or none. We can't see who's voting and how you're voting. It just gives us an idea of where everyone is at tonight. So go ahead and answer. I'll give you a few seconds to do that. And it looks like you're all voting, so it's working for us, which is wonderful. We just have a couple more coming in. Like a lot of you know about stocks. Okay, so looks like 63% of us are pretty familiar with stocks. 38% of us are pretty familiar with bonds. Let me see if I can share this with you. And it's not letting me. 25% of us.
I just shared it, Rachel.
Thank you. 25% of us are familiar with annuities, 38% of us mutual funds and ETFs, and 38% of us none. So this is great because a lot of the information that we're going to talk about tonight is going to cover a lot of these subjects, and hopefully will give you a better understanding of how they work. Thank you for participating in the poll. All right. Your workbook. This is what I had mentioned in your handouts. You're able to download it and follow along if you would like. Also a great resource for later. There's some really helpful exercises. We're going to mention it as we're going along, but there's some really great information in there for you. If you had any issues downloading it, let us know via the questions and we can email it out to you. All right, so we're going to do one more poll. But first, I'm just going to chat a little bit about why do you want to invest? I think we're all sitting here today because for a reason, right? There's something that we're working towards. Maybe it's saving for our first home, or maybe it's saving for college for ourselves or for our children or for a family member. Maybe it's preparing for retirement, or maybe we're already in retirement and we're just trying to prepare for income and taxes. And there could be a variety of other goals. We're all different in what our goals are. So the poll that I'm going to share is, what is your primary financial goal? And I'm going to launch this. Is it saving for retirement? Is it saving for college? Is it saving for another big expense? Is it protecting your wealth? So just choose primarily where you lie tonight, and I'll give you a couple of seconds to answer that question. Okay, so it looks like about half of us are saving for retirement, 25% of us are saving for another big expense, and 25% of us want to protect our wealth. Fantastic. Okay. So it gets you started in thinking about, what is the reason that I'm here? What is it that's important to me? And like I mentioned before, we're all different and we all have different goals and different life. And so having a vision around why we're here can really inspire us as we're learning. Okay. So today we're going to talk about 5 myths and truths of investing. The first myth that we're going to talk about is recessions and bear markets prove that stocks aren't worth the risk. And I think that this is pretty timely as we've just entered another bear market, and it's been almost 10 years since we have seen a recession or a down market. And I'm sure many of us may have grown a little bit skeptical about investing in stocks. And stocks do tend to be volatile, especially around times like what we're going through right now with the coronavirus. They may even cause you to think, well, I don't know if this is right. I'm seeing a lot of loss. Do I stay in? Do I get out? But it's really important to think about long-term investment, right? Over the long run, stocks have historically outperformed other types of investments. And something I just want to mention, a bear market is defined by a 20% decline in stocks from recent highs. And it's an overall pessimistic feeling on Wall Street that typically it can last about 13 months on average. So we have entered a bear market. Let's talk about some things that might give you a little more peace of mind in understanding. So how do stocks work? I'm going to get my little highlighter. So you are the investor. You buy a stock. You are giving capital, which is your money, to a corporation. That corporation in turn is going to give you dividends in the form of cash, or they're going to take their profits and they're going to reinvest them into the company, which becomes capital appreciation. And this is where you see a lot of growth stocks. So you may not be receiving dividends from them, but the profits are being reinvested back into the company in the hopes that the company grows and therefore your stock grows. So let's look at the historical performance of stocks. So this example is looking at if you had started with $10,000 as an original investment in January 1st of 1998, and you had kept that $10,000 original investment invested. And the benchmark that we're using for this is the S&P 500. The S&P 500 is an index that tracks the 500 biggest companies. So think companies like Apple and Amazon. They're really big contenders, right? So if you had put $10,000 in the S&P 500 in 1998 and held it to 2000, your funds would have grown to 16,000. And then if you had held it again until 2007, would have grown to 18,000. And then we saw the financial crisis of 2008 hit, and the stock market dipped down pretty low. So a lot of people lost, went back down to 9,000, which was below your original investment. But if you had held on to it until 2017 or even through 2020, you would have seen it grow, right? $40,000 is where you would have landed at in 2017. So this is just showing, yes, the stock market can dip at times, but having a long-term strategy in place and holding on even when times are rough and not giving up on investing, as long as it's a long-term strategy that you're using, can really end up pretty well for yourself. Okay, let's talk about stockholder risks. So there are three main risks that we want to talk about. The first is market risk. As we've seen, stocks are volatile, especially recently, and they can fluctuate widely with market changes. When the stock market crashes, it tends to pull down the value of most stocks, regardless of the strength of the underlying companies. During times when the market's not doing well, all companies tend to be down. The second is economic risk. Slower economic growth can cause the price of some investments to decline. So for example, certain industries, like we look at the automakers or steel plants, they can't easily cut costs during a recession. As a result, the price of their stock can decline dramatically when the economy slows down. The third risk is company-specific risks. So for example, if you had purchased Blockbuster, I don't think there's any Blockbusters left, except maybe one in Bend still, you would have seen the value of your investment decline as we had Netflix and Redbox come out. So company specific, what is this company doing and how are they going to do going forward? Okay, unpredictability of financial markets over different time periods. So what this is showing is 4 different 5-year increments in the market. So we're looking at 1993 to 1997, where the stock market, and again, we're using the benchmark of the S&P 500, was up 128%. And then you look at 2000 to 2004. 2001 was when the dot-com crash happened. Stocks were down 10%, almost 11%. But then if you look at 2003 to 2007, up again 42%. 2013 to 2017, up 57%. So as you can see, these 4 or 5-year periods, they produced vastly different results. Although the cumulative returns for 3 of these periods were positive, the 5-year period from 2000 to 2004 was negative. So it really just puts it into perspective that you could look at different time frames and get really different results. So lower risk over the long term. So if we were to look at a 1-year period, so for example, this 1-year period here, you're looking at a potential of loss of 15%, depending on the year that you're looking at. The chance of losing money could be about 15%. After 5 years, you have your money in for 5 years. The potential for loss is 13, almost 14%. A 10-year period, your chance of loss reduces drastically to 6.5%. So again, as financial planners, when we're working with clients and we're talking about investing in the stock market, we're always looking at what are your goals. You know, if you have really, really short-term goals, it may not make sense for you to be in the market. It's really a place for longer-term goals where we want to keep up with inflation and grow the funds that we have. All right, that was myth number 1. We're going to dig into myth number 2. bonds are for conservative investors. So many of you might think of your parents or your grandparents or retirees when you think of bonds, or maybe you were one of the lucky ones who got those paper bonds from your grandparents as gifts, and you're thinking that's for conservative investors, that's not for me. The truth is, bonds play a crucial role in any portfolio, regardless of what type of investor you are. Even the very aggressive have a certain percentage of bonds in their portfolios because they add a little bit of stability. What I want to talk about is how bonds work. So this is similar to what we were looking at when we were talking about stocks, but now we're looking at bonds. So you are the investor, and you are loaning money. Instead of buying a piece of the company, you're loaning money to a bond issuer. And we'll talk about the types of bonds here shortly. You're loaning money to a bond issuer, and that bond issuer may be using it for building toll bridges, for growth in their company, depending on what you've purchased. There's a variety of reasons. But what they're doing in turn for your loan is paying interest payments to you. Often it's semi-annual, and you receive that as income while they are using the funds that you gave them for whatever it is that they're working on at the time. Sorry about that. I'm gonna pause this really quick so I can get back on board. Okay, so types of bonds. There are three main types. The first is treasuries. Treasuries range in maturity from 30 days to 30 years. They're backed by the full faith and credit of the US government as to the timely payment of principal and interest. So there's really low risk of default, which makes them something that investors like. The second is corporations. So they can issue bonds to fund large capital investment, or maybe they're working on a business expansion, but the value and risk is associated with corporate bonds depends in large on the financial outlook and reputation of the company that is issuing the bond. So when you're looking at corporate bonds, you really want to look at credit ratings and the solvency of the corporation itself. The third type is municipalities, such as state and local governments. So they might issue bonds to fund the building of roads, schools, or other public works projects. They're generally tax exempt, meaning that the income they generate is free of federal income taxes, but income may also be free of state and local income taxes, depending on where you live. So if you're looking at municipalities, it's always nice to look at what is my state offering, and potentially might it be state tax exempt. Let's look at the historical performance of bonds. Okay, so in this presentation here, we actually have the stock market just as a little buffer there to show you how they correlate with the stock market or don't. But corporate bonds, this orange line here, if you had started with a $10,000 original investment in January of 1998 and held it until 2017, your corporate bond would be worth $31,000, almost $32,000. Treasury bonds is the dark blue line, same investment, $10,000. In 2017 would have been worth $29,000. And if you were to look at municipal bonds, the light blue line here, in 2017 would have been worth $26,000. So I always like to say with the bonds, slow and steady wins the race with this one. They're very steady. You see where they go. And corporate bonds tend to have a higher return because you're taking on a little more risk with them. Treasuries have a really low default. They're very dependable. So you're not going to have as high of a return, but you have that confidence that they're going to be there for you. Municipal bonds are great for the tax advantages that they offer. Because of those tax advantages, they don't always have the higher return. And then you look at the stock market. And the stock market is volatile, right? If you're looking at the gray line, it's going up, it's going down, it's going up again, it's going down again. And in the long term, it usually will end up growing at a higher rate, but with it, you are taking on more volatility. So bonds just add this stability to your portfolio. We know what we can rely on them. We know where they're going, and so it feels good to have them in our portfolios. So with bonds, though they are more steady, they still have their own risks. So one of them is default risk. So that's more associated with the corporations, the risk that the issuer may not be able to pay the interest or principal when it comes due. So research is needed around bonds. You don't want to just go out there and choose a bond willy-nilly. You do want to do some research around the company or the municipality that you're buying into. The value of a bond may also suffer if the issuer's credit rating declines. So if you buy a bond and it has a fantastic credit rating, and then for whatever reason that credit rating goes down and you decided you needed or wanted to sell that bond, you may not be able to get a great price for it because the credit rating has gone down. In addition, bond values fluctuate with changes in market conditions. Finally, bonds are subject to interest rate risk. So generally, bonds values move in the opposite direction of interest rates, which we're going to look at some examples here. So value of a bond when interest rates fall 1%. So this is assuming in this example, you have purchased a bond for $1,000 and it's paying 6% interest. Now, if it was a 2-year bond, meaning you hold it for 2 years, and you had purchased it for $1,000, if interest rates fall, your bond is now selling at a premium, $1,000 and $1,019. The reason for that is because your bond is paying a 6% interest. If you go out and sell it on the bond market, investors like your bond because it's paying a higher interest. They could pay for your bond, get 6% interest, where other bonds that they're looking at are only paying 5% interest. So your bond's paying a little bit more, so they're willing to pay you a little bit more. And the longer term, the more pronounced this is. So a 5-year bond, they'd be willing to pay you $1,043. 20-year bond, $1,125. Now, these examples are really only if you were to sell your bond. If you hold your bond to maturity, it's that $1,000 with a 6% interest. So this would only be if you decided, I don't want to hold this 2-year bond anymore. I'm going to sell it because I know I can get a premium for it. So we're going to look at the opposite. What happens when interest rates rise 1%? So same scenario, you have a $1,000 bond, it's paying 6% interest, 2-year bond, your bond is paying 6%, but other bonds that investors could purchase on the marketplace are paying 7%. So since your bond is not paying as much as other bonds on the market, I, as an investor, am only willing to pay you $982 because I could buy another bond that's going to pay me 7% interest. So bonds, when they have an inverse relationship to interest rates. So if interest rates are going up, bond values are going down, and vice versa. Okay, this leads us into myth number 3. If you invest for the long term, you have nothing to worry about. Oh, I wish that was the case. But there are a couple of things that we really need to keep in mind as investors. Yes, long-term strategy is really, really important, but we also have to consider inflation and taxes. So let's look at some examples here. Inflation. So what I want to mention first is, yes, average inflation is right around 2.5%, 3%, but every product that we buy has its own inflation rate. And so this is just looking at the example of basic cable TV. If the current cost is right around $79 monthly, and historical annual inflation has been 4.8%, we can expect that in 10 years, we're going to be spending about $126 monthly. I know a lot of us may be paying more for cable TV, but this is just very basic, channel 12, 6, 2, just the basics. A postage stamp cost is 50 cents. Historical annual inflation is 4%. Potential cost in 10 years is 74 cents. I know actually costs have gone up a little bit here, but this is just an example. Automobile, $35,000, a little over $35,000 for current cost. And they actually have a higher inflation rate for autos, 5.1%. So in 10 years, we can expect to pay about almost $58,000. So as you can see, inflation can really play a huge part in our purchasing power. If you think about it like this, if inflation were to remain constant at a rate of 4%, the purchasing power of your money is cut in half in 18 years. So if you're putting all of your savings into a savings account that's earning 0.03 or whatever it is these days, you're cutting your purchasing power in half, essentially. And this is where diversification really plays a huge part. Brittany's going to talk a little more about that later. But inflation is something that if your parents were like mine and like to put the money under the mattress, inflation catches up with you pretty quickly. The other is taxes. Taxes play a huge role in your investments. So, for example, the top 25% of taxpayers paid 87% of all federal income taxes in 2015. I know that was just a few years ago, but amounts have not changed much from these times. So you may be thinking to yourself, top 25%, that's not me. Well, the top 25% were households with adjusted gross incomes of $79,655. This is including, if you are married, single. So 79,000, especially if you're living in Oregon, that catches up to you pretty quickly. And so I think a lot of us could say that we're probably in the top 25%, and we are paying a majority of the taxes. So really important to be aware of taxes. Part of what we do as financial planners is we talk about taxes probably more than our clients want us to, but it's really important, especially when it comes to retirement planning. Because yes, your Social Security can get taxed depending on income that you're bringing in. So we do a lot of planning around how can we minimize that. They do play a huge role. So taxes, like I mentioned, take a toll on returns. In addition to reducing your take-home pay, I think we all feel that when we get our W-2, 1099, and we see how much was held for taxes, it kind of hurts a little bit. But before you decide to allocate money to a particular investment, it's important to understand how taxes impact the return on investment. So this example shows someone in the 24% federal income tax bracket. A taxable investment with an 8% return would yield only a little more than 6% after taxes. That's a big difference, especially when you view it over the long term. So how do we combat this? One way is tax-exempt or tax-deferred vehicles. We're going to look at a couple of examples of what that would look like. Advantages of tax-deferred growth. So what this chart shows is if you were making an annual contribution of $5,000 and you were earning a 6% rate of return, what does this look like? So this green box here is a taxable account. So think if you opened a Fidelity do-it-yourself investment account that was in your name, not an IRA, not a retirement account, but just a taxable, simple savings account that you throw some stocks into, let's just say. And it's earning an average 6% rate of return. And then in the orange here, this is a tax-deferred account. So think IRA, Roth IRA, a retirement account of some sort. So if you had put in $5,000 annually, 6% rate of return, in 10 years, your taxable account is going to be worth about $64,000 at a 24% tax rate. where your tax deferred account is going to be worth almost 70,000. So not a huge difference there, but when we're looking more long-term, it really starts to grow. So 165,000 in 20 years, 194, almost 195,000 for the tax deferred account. 30 years, we're seeing more of a gap. 40 years, we're really seeing a gap. So our taxable account is worth 567,000, where our tax deferred account's worth 820,000. I mean, that's a pretty big difference, 300,000. Now this light blue here is if you took your tax deferred account, you retired, and you took a lump sum and paid taxes all at once. Your tax deferred account, moving it into a taxable account, it would still be worth more than your taxable account. So it's just showing tax deferred accounts really make a difference over the long term, even if you're waiting until the very end to pay those taxes. Usually we don't recommend taking a lump sum and paying all of your taxes all at once. There's a lot of planning you can do to minimize this, but this is just for demonstration purposes. Okay, what types of tax deferred accounts are out there? So there are retirement plans, right? So you're working for a company and they offer a 401k or a 403b or 457, something of that nature. So it's pre-tax contributions where you're putting in money before taxes are taken out. Tax deferred accumulation, you're not paying any taxes while the funds are in these accounts. You might have an employer match, which is really fantastic. And what that is let's say your employer says, we're going to match you 3%, then you put in 3% and your employer is going to match that 3%. There are also annual contribution limits. So this year it's 19,500 is the max that you can put in, and your employer can also match on top of that. Excuse me. Okay, IRA accounts. These are held outside of your employer plan. 28% of US households have a traditional IRA, 20% have a Roth IRA. And so the IRS says outside of your employer plan, you can also contribute to one or both of these plans, but there are contribution limits. So for example, excuse me, in 2020, it's $6,000. And you could do $6,000 to a traditional IRA, you could do $6,000 to a Roth IRA, or you could do a combination between the two, but the max is the $6,000. With a traditional IRA, if you're within certain income brackets, you can write that contribution off on your taxes. So it's coming out, you're putting it in, the $6,000, and then you're able to write that $6,000 off on your taxes. The Roth IRA, on the other hand, is after tax. So you are putting it in post-tax, and again, it's subject to certain income tax brackets. But you put in after tax, and it grows tax-free. So the Roth IRA is really great when you're earlier in your career, when you're not subject to the stringent income brackets, and you're probably likely in a smaller tax bracket than you will be later on in your career. And so if we're looking at putting in contributions to a Roth IRA and it sits there and we're contributing for 20, 30 years, 20, 30 years of growth, not paying taxes on that can be a really great tool that we can use, especially in retirement when that is a place that we can pull from. So Roth IRA is a really great tool that we use a lot in our planning, as well as a traditional IRA, really just depending on your specific situation. The other thing to keep in mind with a traditional IRA is if you pull funds before 59.5, you're going to have a 10% penalty, and potentially on earnings for a Roth IRA. So there are age limits too. Annuities. So many of you have probably heard of annuities. There's been a lot of negative media touch on annuities. And the truth is, annuities can be really great tools for certain situations. And that's really where you want to talk to your financial planner if you're considering an annuity or you want to know if it's the right fit for you. It really depends on your specific circumstances. But this just demonstrates how does an annuity work. So you pay premiums for a certain number of years. Often it's pre-retirement that you're paying these premiums to an insurance company. We call this the accumulation phase. So they're accumulating your premiums, and at some certain point in the future, usually this is retirement, you turn on the income. So you stop paying premiums and you turn on the income. And this is what we call the payout phase. And so the insurance company is now going to be paying you income, and we say in retirement because often it's in retirement that you start to receive this income. So you pay in for a certain amount of time and then you receive payments through retirement or for a certain period of time. And we'll talk about a couple of different types of annuities here. So there are three main types: fixed, variable, and indexed. So fixed annuities offer a guaranteed rate of return no matter how the market performs, and they're going to pay you for a guaranteed number of years. So it might be the entire length of your retirement, it might be 10 years, 20 years, really depends on the type of annuity that you have purchased. A variable annuity can invest in a variety of sub-accounts, and they fluctuate with market conditions. So investment objectives of the sub-accounts could be conservative, could be moderate, could be aggressive, depending on you as an investor. So they may outperform a fixed annuity, but there really are no guarantees. If the market experiences hard times, variable annuity investors can run the risk of losing earnings and potentially even principal. So variable annuities come with more risk than a fixed annuity. An indexed annuity is like a hybrid between the two. So they combine the benefits of fixed and variable annuities by offering guaranteed protection of principal, but you'll also have the potential for additional gains. The performance is tied to a market index like the S&P 500. So when the index goes up, so does the return on the annuity. But if the index tumbles, typically the worst that you can do is earn no interest or a guaranteed minimum if one is offered. So index annuities allow investors to pursue market gains while they're still protecting their principal. I see these more often if you come into a large inheritance and you don't need the funds, but you want to save them for retirement, or there are some other situations that we see these, but we don't use them as often. They're just a tool that we lean on for the right situations. Okay, so I am going to pause us here while Brittany takes over. She is going to jump into myth number 4 and myth number 5. And again, if you have any questions, don't hesitate to ask them while we're here. And hopefully everyone could hear me okay.
Okay, thank you, Rachel. I really appreciate that. I think everybody should be able to see my screen now. So Rachel just covered myths 1, 2, and 3. So I'm going to take over for myths 4 and 5. So myth number 4, investing is too complicated. I just don't have the time to think about it right now. The reality is really procrastination can cost you money. And we're going to go into an example of why that is. Okay, so in this example, we have 2 investors. They're both going to invest money over a 10-year period, but they're only going to put money in for 5 years. They're each going to put $5,000 a year, and they're each going to get a rate of return of 6% annually. So Jim is going to start right away. He's going to put $5,000 in year 1 and continue that through year 5, and then he's going to stop years 6 through 10. He contributed a total of $25,000, and his earnings ended up being just under $15,000, making his total portfolio value about $40,000. Now Susan, she's our typical procrastinator. She's decided she just doesn't have the time to think about it right now, and so she's going to wait. 5 years from now, she decides, oh, I really got to get on this. So she puts $5,000 in every year for the remaining 5 years of that time frame. She has contributed the same $25,000, but because she waited, her earnings only totaled just under $5,000. So her total portfolio value is $29,877, which is just under 30. So that's about a $10,000 difference just from procrastination, and that's due to compound interest and making sure that you're capitalizing on gains from previous years. Okay, so it may not be wise to put off investing until tomorrow, but you can take steps to make investing easier. Because selecting individual investments can be a complex process and it requires specialized knowledge, time, attention, many people invest in mutual funds and exchange traded funds. So mutual funds and ETFs, as we call them, are portfolios of securities assembled by an investment company. Their underlying investments are typically selected to track a particular market index, an asset class, or a sector, or they may follow a specific strategy. Because these funds can hold dozens or even hundreds of securities, they can provide greater diversification at a lower cost than you might obtain by investing in individual stocks and bonds. So in spite of their similarities, there are key differences between these types of pooled investments, a mutual fund versus an ETF. So you can invest in a mutual fund through investment companies and generally your employer-sponsored retirement plans. This is what you'll see in your 401k, 457, 403b. Mutual fund shares are typically purchased from and sold back to the investment company, and the price is determined by the net asset value at the very end of the day. So by contrast, an ETF can be bought and sold throughout the day and trades like an individual stock. So if you think, for example, you see mutual fund price is $20 at noon. You put an order to buy that mutual fund at noon. You're not actually going to necessarily pay $20. You're going to pay whatever the net asset value is at the very end of the day, and it could vary from that $20. Whereas with an ETF, you see the price at noon is $20, you put an order in, and you're going to pay that $20. So the price of an ETF, because it trades on an exchange, it's fairly close to what its net asset value is, but due to supply and demand, it can fluctuate and trade at a premium or a discount from its asset value. So why do people invest in mutual funds and ETFs? First, they offer convenience. You may be able to have any of the dividends that you get from a mutual fund reinvested to purchase additional shares. If you invest in a family of mutual funds, you might be able to easily shift the balances among the funds. So if you want to swap it out for a different one in the same family, it's relatively easy. Moving assets between ETFs, however, is a little bit more difficult. You have to actually sell the ETF and buy a new ETF separately. And depending on who the custodian is, you might pay a commission for making that trade. Both mutual funds and ETFs offer a level of professional management. Portfolio managers supply the knowledge and technical expertise for buying, monitoring, researching, and selling securities on a daily basis. Another very important advantage is the flexibility. So both mutual funds and ETFs enable you to customize your investment portfolio. You can choose from a wide variety of styles and objectives that suit your investing profile, and you can adjust quickly to changes in your lifestyle and the market outlook. And finally, we have diversification. So they can invest in a wide range of securities, industries, or asset classes, and this can help to reduce the investment risk and potentially enhance long-term return. So now I'm going to take a look at a couple different mutual fund types and just go into brief detail of each individual one. So money market funds are mutual funds that invest in short-term debt instruments such as treasury bills, commercial paper, and CDs. Municipal bond funds generally offer income that's free from the federal tax rate, which Rachel had discussed earlier, and could be free of state income tax if it's held within the state that you live in. Income funds concentrate their portfolios on bonds, treasury securities, and other income-oriented securities, which might also include high-paying dividend stocks. Growth funds invest in the stock of companies with high potential for appreciation, but very low income. So these are companies that are not paying out dividends, they're putting the money back into themselves, and you're just hoping to see that stock price increase. And that's how you're going to get your returns. International funds invest in both foreign stock and bond markets. And then we have the global funds, which just invest in domestic as well as foreign stock and bond markets. Sector funds invest almost exclusively in a particular sector. So think tech funds, utilities, healthcare, always concentrated in one specific sector of the industry. And then we have aggressive growth funds, and they aim for maximum growth. So they're typically distribute very little income. They have very high growth potential, but they also tend to be more volatile and are considered to be fairly risky. So in general, investments seeking to achieve higher returns also carry a higher and increased level of risk. Okay, so moving on to myth number 5, I can buy a book on investing and just do it myself. Well, what many institutions and financial gurus would have you to believe, that this is completely fine. You know, they have investing for dummies, just get out, read it, do it yourself. While it's really important and a good idea for you to learn as much as you can about investing and doing things to improve your knowledge, like this workshop, that's not going to go the full distance for you. So I have a question. Would you operate on yourself? Probably not. That's what we have doctors for. Okay. So let's look at a couple of proven investment strategies that might best be implemented with the benefit of professional guidance. We have diversification and asset allocation. We're going to look at each of these in a little bit more in depth. So diversification is a basic principle of successful investing. It involves investing in a variety of investments and asset classes in an attempt to limit exposure to losses in any one sector of the market. Different types of investments may react to changing market conditions in different ways. Rachel had discussed this a little bit earlier, had market risk. For example, an unfavorable news story can push stock prices lower. The coronavirus right now can push the entire market lower, while bond values might rise or vice versa. When you divide your money among various investments, gains in one area can help compensate for losses in another. So diversification is a method used to help manage the investment risk. However, it does not guarantee profit or protect against loss. Okay, so we're going to do a fun little poll here. So we have 2 investors. We have Jane, who is going to have a $200,000 investment, and she's going to put it into a single investment. And then we have the Joneses, and they are going to take the same $200,000, but they're going to split it up and put it into 5 different investment types worth $40,000 each. So I'm going to start a little poll here, and you just tell me who you think will accumulate more money over the long run. Excuse me. Got just about all of you voted. Gonna go ahead and close that. And the Joneses, 100% of you have voted that the Joneses are going to accumulate more money. I know this was a simple poll, and we're going to take a look at the next slide and explain why that is. Okay, so again, they both had a $200,000 investment, and they're going to hold it for 25 years. So Jane put all of her money into a single investment. She did pretty good overall, averaged a 6% annual rate of return. She ended up with about $858,000 at the end of the 25-year period. Now the Joneses, they distributed their money in $40,000 increments over 5 different investment types. They experienced some pretty poor investment choices. One of their investments, they lost all of their money completely, $40,000 gone. Their second investment, they broke even. They didn't lose anything, but they didn't gain anything either. So $80,000 of their $200,000 did nothing for them. The next $40,000 is going to gain a 6% annual rate of return. The fourth set of $40,000 is going to earn an 8% annual return. And finally, the last $40,000 earned a 10% return. All in all, they're up $919,000 on their portfolio value. So they're about $60,000 better off than Jane was, even though $80,000 of their original investment didn't do anything for them. It just goes to show how diversification can help you protect against loss, even when an individual investment didn't do so well. Okay, asset allocation is a systematic approach to diversification that determines an efficient mix of assets for a given investor based on his or her individual needs. So this fundamental strategy involves dividing the portfolio into different asset categories. Generally, we're using stocks, bonds, and cash alternatives, and we're trying to seek the highest potential return for that investor's risk profile. It utilizes sophisticated statistical analysis to determine how different asset classes perform in relation to one another, and the overall goal is to achieve the appropriate balance of security and growth potential. So in and of itself, asset allocation is really easy. In fact, whether or not you know it, your assets have already been allocated. You have a 401k, 457, 403b, generally have a retirement account. You might have a taxable account already, or a savings account, or if you're like Rachel's parents, you've got money in the mattress. However, finding the right mix of investments for your individual risk profile, your financial needs, and the time frame is the more difficult part. And it can require careful calculations and the benefit of professional guidance. Again, asset allocation by itself does not guarantee a profit, and it does not protect against investment loss on its own. So let's take a quick look about what you need to do to personalize your asset allocation. You got to take a look at your investment objectives. This is the why. What are you trying to accomplish? Then you need to take a look at your time frame. And lastly, we need to consider your risk tolerance. So we'll go into each of these in a little bit more detail. The first step in personalizing your asset allocation model is to establish your investment objectives. What are you trying to achieve? Are you satisfied with what you have and you're just concerned about making sure you protect its current value? Would you like to see your assets continue to grow even if it means taking on a little bit extra risk? Or are you more interested in generating a steady income that will continue no matter what happens with the market? Your answers to these questions will help determine the appropriate mix of assets for your investment portfolio. So for example, certificates of deposit and money market funds are generally considered to be relatively safe investments, whereas stocks, certain mutual funds, and exchange traded funds, as well as variable annuities, allow investors to pursue a little bit of growth right here, but they also accompany a degree of risk. Bonds and fixed annuities can help generate a steady stream of income that's attractive to many retired investors. Dividend yielding securities are another alternative, although they typically involve a little bit more risk. And so it's important to understand that dividends are paid at the discretion of a company. So in general, once a company has started paying dividends, they usually will continue to pay them, but there is no guarantee that they're going to continue. So you run the risk of them deciding to stop paying a dividend or reduce a dividend in the future. Sorry about that. So the FDIC insures CDs, which generally provide a fixed rate of return, and they're insured up to $250,000 per depositor. And so generally when you're looking at a savings account, when you go into your bank and it says FDIC insured up to $250,000, that's what they're talking about. Okay, so the second step in personalizing your asset allocation model is to identify your time frame. The amount of time that you have before you need to reach the goal you have is a huge impact on your investment categories that you're going to choose. So that's because the fluctuations in the financial markets can affect the short-term value of certain investment types, example, stocks. So if you are trying to save for retirement and you expect to retire in 20 years, you may be able to invest more aggressively because your portfolio has more time to recover from the short-term market fluctuations. However, if you're investing for your child's college education and they're a freshman in high school at this point, then you're going to want to invest more conservatively to help shelter the portfolio from potential losses because you don't have enough time to swing back from any short-term market fluctuations. Okay, so earlier we looked at the performance of stocks and various bonds over a 20-year period. And so what this graph is showing us is the volatility and historical performance of stocks, corporate bonds, and T-bills over a 25-year period. So of course, keep in mind that past performance is no guarantee of future results, but in general, this graph is just an idea so you can get a pretty good close approximation of what volatility looks like. So of the three types of investments shown, stocks perform the best over time, average 9.69% annual rate of return. However, the performance of stocks can be unpredictable. As you can see, the huge swings we've got here, this is the market dip in 2008, and then a pretty big surge right back up and relatively steady within a channel, however, still swinging quite a bit as we move through to 2017. So because of the characteristics and the volatility of stocks, most people suggest that you don't want to invest in them if you have less than a 5-year time horizon of when you'll need the money. So for example, we talked about just a little bit briefly, your kid is going to college and they're a freshman, not a great time to be invested mostly in stocks. Historically, corporate bonds have not performed as well as stocks over time, 6.45% on an annual rate of return, but their volatility is flattened out significantly in comparison. That's the green line here. On the other hand, Treasury bills, they perform about 2.5% annual rate of return over this time frame, and the volatility is relatively flat. So these are considered to be a conservative and safe investment. So as you can see, the investment classes have performed the best, also have fluctuated the most widely from year to year. It's a powerful reminder of why it's important to keep your time frame in mind when developing your asset allocation model. It's not a one-size-fits-all when it comes to investing. Excuse me. The third step in personalizing your asset allocation model is to identify your risk tolerance. This means evaluating how much risk you're willing to take to reach your financial goals. It includes the ability to watch the value of your investments fluctuate without becoming queasy. So as financial advisors, that's what's more important to us. Everybody likes to see the upside. Almost everybody, whether you're a conservative or an aggressive investor, like to see it increase. But what a risk tolerance tells us is what is your capacity to handle the downside. Market performance during bear market and bull market periods has tested many investors' risk tolerance and driven home the fact that risk tolerance is an essential consideration. Okay, so here we're going to look at two sample asset allocation models. The first one here is a conservative investor. They have a 20-year time frame, and their primary goal is to minimize volatility. So in this case, they're just trying to protect the assets that they have. We're going to put them in a 50% bond, a 20% cash alternatives, and a 30% stock portfolio. For this investor, over that 20-year time frame, their best year was 16.67%, worst year down 13.23%, but on an average basis, got 5.81%. So now we're going to look at an aggressive investor. This is the opposite end of the risk profile. Same 20-year time frame, but in this case, primary goal, pursue growth. They want to see those assets grow. Here we're going to do a 80% stock portfolio, 15% bonds, and 5% on the cash alternatives. Over that 20-year period, the best year, 24.46%, but worst year, negative 30.33%. So that would make just about anybody feel a little sick to their stomach. Average annual return on this one, 6.85%. So this is just a good graphical representation of what I just talked about. Almost everybody is happy with the upside, but what we're really looking at here is this number. What is the downside that you can handle? So an investment professional can help you not only understand your investment objectives, your time horizon, and your risk profile, but also help you to keep your expectations in check and thus help avoid disappointments. So here we're going to look at a couple different time frames and how investor sentiment changed over time. So investors polled at the end of 1999, just before the bull market hit its peak. Investors were expecting 18.4% return from the stocks in 2000. By September 2003, after the economy had fallen into a recession and the markets had suffered the downturn, investor expectations had fallen to 8.5%. So it's a relatively short time period from 1999 to 2003, and you can see the big dip in how much investors wanted to get back on their investments. As the market started to rebound in 2009, following the Great Recession, investors were a little bit more optimistic about what the market would do. However, due to what had just happened, and after getting a double-digit year of performance in 2013 and 14, followed by a flat year in 2015, and then back to a double-digit in 16 and 17, investors were a little bit more cautious and not quite sure what way that they felt the market would go, and thus their expectations rounded out at about 8% annually for 2018. Because your financial strategy depends on the return that you expect from your investments, it's important to be realistic about the return your portfolio will actually yield from one year to the next. It is unrealistic to think that markets will perform the same way every year. While I would love to see an 18.4% annual return indefinitely, that's highly unlikely to happen. Inflated expectations can cause you to overspend or fall short of your goals. So the more conservative approach is to expect a lower number and save more. And if you're fortunate, you can reach your goals earlier than expected if the markets did better than what you thought. You might be asking yourself, do these strategies really work? So let's look at a hypothetical case that applies the diversification and the asset allocation to a real world example. So here we have two investors, Robert and Karen. Both began saving in 1998. They both hoped to retire in 2019. Both of them are going to put $20,000 annually into their investment portfolio, and their retirement savings goal is $1 million. So let's take a look at how they did. Robert had always believed that the stock market was a place for gamblers. He didn't like the idea of putting his hard-earned money at risk. So as a result, Robert decided to take a relatively safe approach to investing. He put 60% of his money into treasury bonds, 30% into corporate bonds, and 10% into CDs. Through the years, Robert's portfolio grew, slow but steadily, and suffering only 1 year of loss. At the end of 2017, sorry about that. At the end of 2017, on the verge of retirement, Robert was about $320,000 short of his $1 million goal. Now, Karen's approach to pursue her retirement goal included investing in growth-oriented stocks. So based on her 20-year investment time frame and her personal risk tolerance, she invested that $20,000 a year in 60% stocks and 40% corporate bonds. Karen's balance by the end of 2017 was $930,000. She benefited by having a higher percentage of stock and bond investments within her portfolio. Okay, so recap, what can we learn from these two scenarios? Not only is investing unpredictable, but it can take more than 20 years to accumulate enough money to enjoy a comfortable retirement. Remember that market events can deal investors a bad hand. Exactly what we're seeing right now with this coronavirus. Robert's conservative approach enabled him to earn a small but steady return and helped him to avoid significant losses. So in this case, Robert would have been less affected by the coronavirus than Karen would have. However, he was significantly short of his overall goal. Over this period, he only averaged a 4.85% annual return. And this illustrates that many investors may want to consider allocating a portion of their portfolios to growth-oriented investments, even though they have a slightly higher risk profile. Although Karen was unnerved by the volatility of the stocks, especially in 2001, 2002, 2008, if she was still investing now, would be a good example. She maintained her balanced asset approach. So she kept it 60% stocks, 40% bonds. This approach helped to smooth out the effects of extreme market ups and extreme downs, and thus her portfolio earned a 7.5% average return, and she was able to accumulate about $250,000 more than Robert. But both Robert and Karen now need to decide whether to retire on schedule or live on a reduced retirement income, or do they work a little bit longer because they didn't reach their goals. So they're going to have to make some decisions on how can they accommodate for the fact that they didn't quite get that full $1 million. Karen is going to have to do a lot less. Robert's going to really have to put in a lot of effort to make sure he gets there. Many people today are in a similar situation or worse. The market turmoil in 2008 and early 2009 took a heavy toll on the nest eggs of Americans, and many investors reduced their exposure to equities even though the conditions later improved. Rachel had showed a slide a little bit earlier about the market dip. You lost from your original $10,000 investment. It was up to 18, you fell down to 9, and then it shot back up to 40. And that's a good example of what happened to people in 2008. They pulled out, but they couldn't get back in time. Okay, so there's several ways that you can proceed from here. You can do it yourself. You can dig through all the prospectuses of different investments and interview investment managers and gradually assemble a portfolio that can meet your needs. It's a lot of work, but you can certainly do it. You can work with others. Maybe you know investment professionals or have contacts or an uncle that's super stock savvy that can help you out. You can work with us. We hope you feel comfortable about our professional knowledge and the approach we take with our clients and making sure that we're looking at every single aspect that affects your investment decisions. Finally, you can procrastinate. Given the nature of the markets, it's not a prudent move and we do not recommend it. Of course, we hope that you'll take advantage of meeting with us and our complimentary consultation that we offer to everyone who does a investment seminar with us. We give you a chance to come in and we'll talk with you, learn a little bit about what it is that you're trying to accomplish, what you've already done, and help you decide where you need to go from there. Okay, we're just about ready to wrap this up, guys, and I think that we're right on time, which is great. So at the end of this webinar, you will get a survey that will pop up. This is what the paper version would look like, but the questions are the same. The most important ones for us is question number 1. Are you interested in scheduling a complimentary consultation? Now, it's no pressure, but it helps us to understand whether we do need to reach out to you and make sure that we can get you on the schedule. The rest of the questions, just let us know how we did. Were there things that you liked, what we could improve on, and what types of topics you would like to hear about in the future. There's also going to be a comment section at the end, and if you're not interested in scheduling an appointment, which is completely fine, but you do want to attend more webinars and seminars in the future, just put, attend more seminars at the bottom and we'll keep you on our mailing list. If you do decide to come in for a complimentary consultation, I have a few items that is helpful that you bring. However, they are not necessary. The first meeting is generally a really high-level overview of what you've done, get an idea of who you are and what your goals are, and how we might be able to work together going forward. But it is helpful to have your last year's income tax returns. Knowing where your income is at, both last year and what it might be this year, is super important for us in making investment decisions for you. Because if you're in a low income tax bracket versus a high income tax bracket, the recommendations we make are going to be vastly different. If you have life insurance policies or annuity contracts already, those are important for you to bring. And just a high level overview of what your assets and liabilities already are. So Rachel had mentioned that there's a few handouts provided to you. One of those is a workbook. On pages 18, 19 of that workbook, you'll find a worksheet that is designed to help you gather some of the important information that we or any financial advisor would need. And then during our consultation, we'll review the data. And then of course, like I said, if you can't find these pieces of information, come anyways. It's not necessary at this point in time. So we'd like to thank you all very, very much for coming to the seminar. We're going to now open it for